Hey everybody, welcome to Mortgage Today for Tuesday, October 3rd, 2023, and oh, what a day it was. UMBS were losing another 48 big basis points in the first hour this morning. S&P futures opened up 26.75 points, so I guess all the money was flowing to stocks. Traders and analysts are sitting in a circle and nodding their heads in approval as EU and US yields were flat to slightly lower around 4:30 a.m. Then Reuters had just published a piece entitled Bond Sell-Off Takes Breather. Less than an hour later, bond yields had spiked to new long-term highs and Treasury yields were in tow. There was no obvious motivations or volume spikes to suggest any underlying inspiration beyond the same old repricing theme. Say it with me now, higher for longer. Then we got the JOLTS data, so job openings and labor turnover data. So there were 9.61 million job openings on an 8.8 million forecast. It was 8.92 previously. The quits rate was 3.638 million versus a 3.549 previously. Lower is better for rates, unfortunately. JOLTS was the week's first massively important economic data, and it is not good for bonds. Fear of a number like 9.6 million is the reason for yields backing up heading into this week. The reality of a 9.6 million is worth a quick push back to opening highs. Then we got home prices rose 0.68% according to Black Knight. This pushed the annual growth rate to 3.8%. Rising home equity means there are opportunities for cash out refis in this market because debt loads are gigantic. People just keep buying shit. Cleveland Fed President Loretta Mester said that investors should expect one more rate hike this year. Bowman is calling for two moves. Fed Vice Chair Barr said they are likely at or very near a level that is sufficiently restrictive. Bostic has no urgency to raise again, and Kashkari thinks there will be more. The JOLT survey is not a report we paid much attention to as a market mover until the past year or two. Since then, it has been increasingly mentioned by the Fed. That alone is reason enough to pay attention, but it also able to teach investors things about the labor market that don't show up as readily in other data. It has been trending lower and arguably still is, but as was the case in February and June, job openings popped higher into a position where the subsequent increase would break to the downtrend. Bonds were nearly unchanged before this data, but sold off abruptly in its wake. Both 10-year yields and mortgage rates hit new long-term highs. UMBS ended the day down 63 basis points. The 6% coupon is at 97.47, which is barely even on the chart. It's so far below any trend lines for moving averages, blown through all the Fibonacci's and way down and creating this brand new ugly range. We also have news that the funding structure of this is being decided by the Supreme Court, which could have an impact on the regulatory framework of the mortgage industry. The CFPB has made no friends with the mortgage industry over the years, and it was originally intended to be immune from any sort of democratic checks and balances. The head could only be fired for cause, and the funding structure was exempt from the normal appropriations process, which is how congressmen, senators influence things. The MBA is warning that a ruling against the CFPB could upend the mortgage market if the Supreme Court rules that the current funding structure and regulations, and like QM, are no longer valid.